Very good evening to all of you. On behalf of Committee for Members in Practice of Institute of Chartered Accountant of India, I welcome you all in this VCM on key changes in lease accounting under accounting standard as well as IND AS. That is, earlier it was AS 19, now IND AS 116. In order to cater these two technical topics, we are having with us two eminent speakers, CA Achal Jain ji as well as CA Monish Sharma ji. Welcome to both the eminent speakers, sir. Welcome. First technical session, we'll start with the key changes in the IND AS, versus AS and IND AS. And in order to tackle this, we are having with us CA Achal Jain ji. Achal Jain ji will discuss the various differences earlier, what was there and now what is there in this IND AS. So let me share with you the brief profile of Achal ji with all of you. Achal ji is a chartered accountant from ICAI as well as a BCom honors from University of Delhi. He is currently into practice with a specialization in assurance and advisory practices. Prior to this, he worked with assurance and advisory practice of Deloitte, Haskin and Sells, SR Bartleby and Company LLP, and Walker Chandhyok and Company LLP, Grant Thornton. He has more than 14 years of post-qualification experience in accounting, audit, and financial reporting. In his role, Achal has managed statutory audit engagement for several clients with presence in India and overseas. He has also assisted Indian and global companies in transitioning to the IND AS, IFRS implementing complex accounting guided relating to the IFRS, US GAAP, and Indian GAAP. He is having more than 14 years of post-qualification experience in AASB. During his experiences, he has gained extensive experience in serving large and medium-sized corporate across various industries under IND AS, IFRS, US GAAP, and Indian GAAP. Some of his experience includes companies like Tata Steel, BSL, Tata Chemicals, Escorts, Jindal Stainless Steel, Ashok Leyland, Hero Group, Bata, MR, MGF, Bharti, and the list is very vast. He has worked on various publications for Big Four firms which covered various aspects relating to IND AS and IFRS. Some of them are, let me share with you. He has also assisted clients with various IPO projects. He has also considerable experience in providing training to the clients on IND AS, IFRS, and US GAAP. He is an active speaker with the Institute of Chartered Accountant of India for various IND AS training programs and other programs organized by ICAI. He is a member of the study group of ASB. He is also the technical reviewer with the FRRB Financial Reporting Review Board of the ICAI. He is having the knowledge of reporting requirement under IND AS, IFRS, US GAAP, and Indian GAAP. He has a significant experience in assisting clients across industry sectors, manufacturing, real estate, power, construction, service sector, media, and trading. And he's having considerable experience in conversion of the projects from Indian GAAP to IND AS, IFRS, and US GAAP. So without wasting much more time, may I request Achal ji to please start his deliberation. Please, Achal ji.
Sure. Thank you so much, sir. And welcome all of you for this discussion on leases, wherein we are going to, first of all, touch upon the aspects related to the accounting that we have been doing under Indian GAAP, and then we'll also compare this Indian GAAP accounting with as to how the things have been changing under IND AS, and now with this IND AS 116 in place, how the things are significantly changing under IND AS 116. So I'll just start with some of the basic aspects related to leases under Indian GAAP, that is accounting standard number 19. We are all familiar with this accounting standard, so that's why I'll not get into detailed discussion on this. I'll just touch upon quick aspects related to this. So if we talk about Indian GAAP today, AS 19, the way leases has been defined over here is completely different from the way now the leases get defined under IND AS 116. So let's understand how the leases are defined under Indian GAAP. Lease is an agreement between two parties, lessor and the lessee. And in relation to this agreement, the party which is lessor will convey the right to use of an asset. So now lessor is a party which will convey right to use an asset to the lessee. And in return for this, lessee will make the payment to the lessor. Now this payment could be a one-time payment, or this payment could be a series of payments. So that is how this arrangement really works, which is which is then called as a lease arrangement. And this is definitely for a fixed period of time. And this time period is something which we generally call as the lease period. So this is how lease agreement is defined under Indian GAAP. Now, if you just look at some of the aspects in this definition, this focuses on the transfer of right to use. So currently under Indian GAAP, lessor is transferring the right to use of an asset. Now, when we talk about IND AS 116, over which you'll have a detailed discussion in the next hour, you will understand that this definition has changed, and now it is no longer a right to use which is conveyed by the lessor to the lessee. This is basically about the right to control the usage. Yeah. So now this control aspect has been brought in as against the right to use. Secondly, if we talk about Indian GAAP, under Indian GAAP, there's a lease classification into operating leases and finance leases. And irrespective of the party which is involved, that means irrespective of whether it is a lessor or a lessee, this lease classification has to be done. So before we get into the accounting requirements, the first step under Indian GAAP, any party will follow will be on the assessment of this lease as to whether this lease will become a finance lease or an operating lease. And let's just quickly understand what do you mean by these two types of leases and how do we do this classification. Indian GAAP defines a finance lease, and it says that if the lease requires transferring substantially risk and rewards related to the asset. So the asset for which right to use is conveyed by the lessor to the lessee, if such an arrangement involves transfer of substantial risks and rewards from the lessor to the lessee. So we are not transferring the ownership. We are just transferring risk and rewards, and the risk and rewards which are getting transferred should be substantial. Now, in case the lease arrangement requires this substantial transfer of risk and reward, and this is also the substance of the arrangement, then such an arrangement under Indian GAAP is called as finance lease. And any lease arrangement which is other than the finance lease is considered as an operating lease. Now, what does it mean? It would mean that if we are looking at a lease arrangement, but such a lease arrangement does not transfer substantial risk and rewards in relation to the asset from the lessor to the lessee, then in such a scenario, it will not become a finance lease. It will be a lease, but it will be limited to an operating lease. Okay. So this is how finance lease and operating lease are defined. Now, in relation to finance lease, accounting requirements are different as compared to the operating lease. We all understand under Indian GAAP that whenever it comes to the finance lease, the accounting aspects which are involved in the lease impact the balance sheet of the lessor as well as the lessee. Means finance lease gets recorded in the balance sheet of both the lessor as well as the lessee. But when it comes to the operating lease will not impact the balance sheet of either the lessor or the lessee. So that means if the lease is an operating lease, it will only have an impact on the profit or loss of the parties which are involved. That means the lessor and the lessee. Now, this is something which has changed significantly under IND AS, and I'll come to that aspect slightly later. Let us just first of all understand in some more detail as to how this classification can be assessed under Indian GAAP itself. Now, under Indian GAAP, in relation to this classification into finance lease and operating lease, standard gives us some indicators. If these indicators would be existing in the lease arrangement, then the lease arrangement may be classified as a finance lease. But If none of the indicators which are available and which we are going to discuss now are available in the lease arrangement, then such a lease arrangement will not be considered as a finance lease. So let's just understand some of these aspects. Transfer of ownership. So if the lease arrangement requires that the ownership of the asset will get transferred to the lessee, not at the beginning, not at the inception of the lease, but when the lease arrangement comes to an end, automatically the ownership will also get transferred. Or let's suppose if the lessee, after the lease agreement is over, will get an option to buy the asset under lease at a price which is below the market price at that point of time. But this understanding is available at the time of inception of the lease. Then in such a case, let's try to understand the substance of this transaction. So in substance, what is happening? In substance, if we understand this transaction, during the period of the lease, all the risk and rewards related to the asset will be enjoyed by the lessee. And once the lease agreement is over, ownership will get transferred to the lessee. So effectively, all the risk and rewards related to that asset will always be with the lessee only. Yes or no? So that's why in such a scenario, standard says that such a lease should be considered as a finance lease. Now, having said that, there are some more factors which will also require lease to become a finance lease. For example, if let's suppose lease period covers substantially the economic life of the asset, that means if the substantial economic life of the asset is covered in the lease arrangement, wherein the economic benefits attached to that asset will be available with the lessee, and after this lease arrangement is over, only a small part of the economic life is pending. So effectively, who has got the economic benefits attached to that asset? Lessee only. So that is again one of the ways through which a lease can be structured as a finance lease. Or it could be the one wherein the asset is of specialized nature. Means the asset is something which will be usable by the lessee only and nobody else. Means even if lessor tries, it will be not of any use either to the lessor or to any other party but the lessee. So that's why there again, what do we say? That effectively it's a kind of arrangement wherein these two parties are just trying to pass on effectively all the economic benefits to the lessee. Similarly, this standard also requires one sort of test wherein one can check about the minimum lease payments. Now, what are the minimum lease payments? Minimum lease payments means the lease payments or the payments which the lessee will make to the lessor over the lease period. Now, if the minimum lease payments in terms of their present value substantially equal the fair value of the asset at the time of the inception of the lease. So there again, if we understand this transaction, what has happened? Effectively, lessee has paid for the substantial part of the asset. Yeah, so there again, what is it that we're just trying to understand? That effectively it's the economic benefits which have been passed on to the lessee in a substantial manner. Now, looking at some of these examples or these indicators, one can very well assess, and it's quite easy to understand that it's a kind of structuring between two parties, wherein even though the ownership has not been passed on by lessor to the lessee, but still all the risk and rewards, if you'll see, are available to the lessee itself. Yeah, so that's why such an arrangement requires a specific type of accounting as compared to any arrangement which is not a finance lease. Now, similar to this, there could be various other indicators which the standard also talks about. And as we have discussed that these are only the indicators. In substance, what do we need to check? In substance, we need to check whether the risks and rewards substantially are getting transferred to the lessee or not. If that is the case, then yes, it's a finance lease, otherwise not. Now, some of the things which Indian GAAP requires us to look at is the assessment of finance lease, and that has to be done at the time of inception of lease. Secondly, even though Indian GAAP also gives us these indicators for us to get into the assessment of finance lease versus the operating lease, but we need to understand that those are only the indicators. Indicators are not the exhaustive list. We need to understand the arrangement. We need to understand the intent of both the parties, and we need to look at the substance and not really the legal form of the arrangement while doing this assessment. Yeah. So this is briefly about some of the aspects which are involved in terms of classification of leases. Now let's understand how is this lease accounting required to be done. Now, if in case it's a finance lease, then the standard requires that because the substantial risks and rewards are passed on to the lessee and they are not with the lessor. So that's why it's the lessee who should record this asset. So the lessor will not record the asset on lease, and we are talking about the asset for which the right to use has been transferred to the lessee. So the lessee is the one who will record this asset on lease in its balance sheet. And corresponding to this asset, because the ownership is not there with the lessee, so that's why corresponding to this asset, lessee will also have an obligation to pay to the lessor. So that's why along with this asset, lessee will also record those obligations in the form of a liability. So that's why whenever the finance lease accounting will start, lessee at one place will record the asset on lease, and corresponding to this will also record the finance lease obligations in its balance sheet. Now, because the asset is now sitting in the balance sheet of the lessee, so that's why over the lease period, it's the lessee who will take the depreciation charge in its financial statements. And in respect of these obligations, which the lessee would have recorded in its balance sheet, standard requires that these lease obligations should be recorded at their present value, which means that let's suppose over a period of 5 years, 1 lakh per annum is required to be paid by lessee to the lessor. So over a period of 5 years, what is the liability that we see in respect of the lessee? 5 lakh. But standard says that the lessee will not record this 5 lakh. Instead, lessee will record the present value of this 5 lakh in its balance sheet. Now let's suppose using some discount rate, this present value comes out to say 3,50,000. Okay, so now on day 0, what do we see? That the lessee has a present value of the lease payments amounting to rupees 3.5 lakh. Now against this 3.5 lakh, the actual payout from the lessee to the lessor will be 5 lakh. So there's a gap of 1.5 lakh, which needs to be bridged. And how do we do this? For this, the standard says that this liability should be trued up to its value which is required to be paid over the period of the lease. Or you can say this is also a kind of unwinding of discount on this liability. So over the period of the lease, on this present value, interest will be computed. Interest means the time value of money which was discounted at the time of recording this liability, and along with this interest, this liability will be compounded, because of which what will happen over the period of 5 years, liability will true up to its value of 5 lakhs. Yeah, but because the initial liability was recorded as 3.5 lakh and the actual liability which is required to be paid is 5 lakh, so that's why this gap of 1.5 lakh needs to be recorded in the form of interest expense, or you can say a finance cost over the period of the lease. And this is something which will compute on the closing balance of the finance lease obligation at every reporting date. Now, this is an aspect related to the lessee which is required to be considered in case of a finance lease. Now let's understand how will the lessor record this. Now lessor doesn't have this asset now, even though he continues to have the ownership of the asset. Still, because the risk and rewards have been substantially transferred from the lessor to the lessee, so that's why lessor will not record that asset in its balance sheet. Okay, so let's suppose if we are talking about a building which the lessor has given to the lessee, so lessor will not record building in its balance sheet anymore the moment we say it's a finance lease. So what will the lessor do? Lessor will have to just move out the building out of its balance sheet. But instead of this, what will the lessor record? Over the period of the lease, lessee is recording the finance lease obligations, means the amount which the lessee is required to pay to the lessor. Now this amount will be recorded by the lessor in its balance sheet in the form of lease receivables. And these lease receivables are again at the present value only, because this is something which is corresponding to what the lessee would have done. So that's why lessor will also be recording a lease receivable, but the lessor doesn't have the asset which has been given to the lessee, and that's why in its P&L, lessor will not be charging the depreciation, because if the asset doesn't stay any longer in its balance sheet, it can't charge the depreciation. Over the period of the lease, in relation to this receivable which the lessor will be having. Now, if we just use the same example which we discussed for the lessee, let's suppose lessor is required, or over the period of the lease term, lessor will be receiving 5 lakhs. And today, the receivable has been recorded at 3.5 lakh. Let's assume the numbers are same. It may not be same always. Let's assume this is 3.5 lakh. Now, the actual payment which the lessor will receive is 5 lakh. So that's why this receivable also needs to be trued up to its value over the period of 5 lakhs. So that's why in case of lessor will now accrete interest on this receivable. And this interest will be a kind of finance income, or you can say interest income to the lessor. Yeah. So now, if we understand the finance lease accounting, just to quickly summarize, for both the lessee and the lessor, there's an impact on the balance sheet, correct? And in respect of the lessee, this is getting recorded in the balance sheet of the lessee as an asset, and that's why lessee is also charging depreciation on the same. And both the parties are recording the receivable and the payable, on which there's a finance income and finance expense. Correct. Now, going to next lease classification, which is operating lease. For an operating lease, we understood that the risks and rewards are transferred, but that is not a substantial risk and reward which has been transferred from the lessor to the lessee. That's why whenever such a lease accounting is required to be done, there will not be any recording of such an asset in the books of the lessee. So lessee will not record this asset. So if we don't record this in the books of the lessee, so what will happen? Lessee will not be able to charge depreciation. But over the period of the lease rentals will be paid. And because these lease rentals will be paid, so what will happen? As and when the lease rental will be paid, there will be a charge to the P&L. Now let's understand the accounting of the lessor in case of an operating lease. Because the asset is not recorded in the books of the lessee, lessor continues to have this asset in its books. That's why lessor will be charging the depreciation on this asset which has been leased out. Now, this is different from what we have seen in case of finance lease. Secondly, over the period of the lease, as and when lessee will pay lease rent to the lessor, so lessor will receive the lease rent. So for lessor, it will be a lease income as compared to what the lessee is doing as a lease expense. So now, in case of an operating lease, if we have to just understand its impact, there's nothing which is impacting the balance sheet of lessee. Why? Because operating leases are not getting recorded in the balance sheet of the lessee. They are only impacting the P&L. Correct? Yeah, they are only impacting the P&L. Other than this, Indian GAAP also requires straight lining of the lease rentals. Now, straight lining means that if over the period of 5 years, let's suppose every year lease rent increases by 20%. Say, for example, every year it increases by 20%. So the standard says that instead of recording the actual amount which has been paid out as a lease expense, it should be straight lined. Means amount for all the 5 years should be computed and its average should be worked out. Say, for example, in the first year, rent was 1 lakh. In the second year, rent was 1,25,000. In the third year, it became 1,50,000. In the fourth year, it became 1,75,000. In the fifth year, it became 2 lakh. Okay. So over the period of 5 years, we see escalations in the lease amount. Now, if we compute the average of this comes out to 1.5 lakh. Or you can say, if we want to straight line these 5 payments, so what will it become? 1.5 lakhs. Now, in the first year, even though lessee will pay 1 lakh, lessee will record an expense of 1.5 lakh. And the impact will go to lease escalation reserve. In the second year, even though he will pay only 1.25 lakh, he will record 1.5 lakh. In the third year, he will pay 1.5 and will also record 1.5 lakh. But in the fourth year, he will be paying 1.75 lakhs, but he will be recording 1.5 lakhs. So in such a scenario, in the fourth year, what will happen? The lease escalation reserve, which would have been created, that will start getting reversed. Or you can say that will start getting adjusted. So over the period of the lease, in our example, this was 5 years, we will see that the impact will become neutral. Okay, so over the period of 5 years, this lease escalation reserve will become zero. This impact will become neutral. But every year, there's an impact. Yeah, so if you look at it on year basis, impact is there, but over the period, there is no impact. But this is something which the standard requires us to do. And this straight lining is not only required by the lessee. Now, again, under Indian GAAP, I've seen a lot of practices wherein the lessee is doing the straight lining, but the lessor is not doing the straight lining. So the lessor is also required to do the straight lining under Indian GAAP. Okay. Now, for the lessee as well as the lessor, we have understood the accounting both under operating lease and the finance lease. And we have seen that it's only the finance lease which is impacting the balance sheet of the lessee and the lessor and not the operating lease. Correct? Yeah. Now, moving further, I think we can just quickly look at this balance sheet impact summary for both. If we look at lessee, operating lease is something which is completely off balance sheet, means which is only impacting the P&L. And finance lease is something which is impacting the balance sheet because there's a leased asset on the balance sheet of the lessee and there's a lease liability on the balance sheet of the lessee, and P&L impact of course is there. If we look at the lessor, for lessor, there's a leased asset in case of operating lease which continues to be recorded in its balance sheet, but in case of finance lease, it goes off, and as against this leased asset, a lease receivable gets recorded in its balance sheet. Correct? Yeah. So now this is broadly about the Indian gap that all of us have been following over the period, and I'm sure you were quite familiar with most of these requirements. But idea was to just to take you through some of these concepts under the Indian gap, so that we can just sort of now compare some of these requirements as to how they have been changing under IND AS. Now, moving on to IND AS. Under IND AS, when we started off, we had IND AS 17 in place. Means when this IND AS was introduced for the first time for the companies in India, so IND AS 116 was not the standard, it was IND AS 17, which became applicable to all the entities. And subsequently, IND AS 17 got replaced by IND AS 116. And this is something which was applicable for the accounting periods starting from 1st April 2019. Okay, wherein this IND AS 17 got replaced by IND AS 116. So now, if we now look at the IND AS scenario, so we have IND AS 116 applicable for all the companies which are on IND AS. Now, currently as we stand, so we have already seen 2 reporting periods are gone by. So 1920 and 2021 are gone by, and we have seen that the things have already got settled in terms of the implementation of this new standard also. New standard means I'm talking about this IND AS 116. But before this discussion about the difference between Indian GAAP and IND AS 116, let us quickly understand some of the changes which have taken place during this period from the companies which have moved from Indian GAAP to IND AS 17 and then to IND AS 116. If we compare Indian GAAP, that means AS 19 with IND AS 17, the changes were not so significant in terms of the accounting requirements in relation to classification of leases, in relation to accounting of the lessee as well as the lessor. Means under IND AS 17, similar to what we were doing under AS, that means under Indian GAAP, both the lessees and the lessors were required to do the lease classification. Both of them were required to do the lease classification. Means both of them had to assess at the time of the inception of the lease whether the lease will become a finance lease or an operating lease. And if the lease was the finance lease, then its accounting was different as compared to the operating lease. If we look at the accounting requirements for the lessor as well as the lessee under IND AS 17, which is now gone, again, there was hardly any difference in terms of the accounting requirement. Though there was an appendix along with IND AS 17, which is very popularly called as IFRIC 4 under IFRS, which was dealing with the lease-like arrangements, which was significantly different from Indian GAAP, because under Indian GAAP there was no such guidance. Now, this IFRIC, or you can say this guidance under IND AS, talked about some of the agreements which, even though were not structured in the form of a lease, means legally they were not called as the lease agreements, but still standard required us to assess and to check whether in substance they would become the lease arrangement or not. So we were required to get into the substance of that arrangement, and in case in substance that arrangement become a lease arrangement, then the accounting for those agreements was required to be done as if it was a lease as per the requirements of IND AS 17. Now this was one of the biggest shift when the companies moved from accounting standards to IND AS, because there were a lot of companies across the sectors which were impacted by this IFRIC, and because of which a lot of transactions, a lot of agreements got recorded in the form of a lease, which were not getting recorded as lease earlier. And this was one of the significant changes which impacted the sector during the course of IND AS implementation. Now, this standard is also gone because now this standard has been replaced by IND AS 116. So that's why I'll not be getting into too much details around this standard. Now talking about IND AS 116. IND AS 116 is a further shift from IND AS 17 in terms of the accounting requirement. Over the years, as we have seen under Indian GAAP and which we also saw under IND AS 17, that the leases were getting recorded on the balance sheet of the lessee only in case it was a finance lease. But let's suppose it was not a finance lease. Let's suppose lease was only an operating lease. Then nothing was getting recorded in the balance sheet of the lessee. Now this is something which was having an impact on the understanding of the financials of any entity. Let's try to understand why this change was specifically required and why some of these changes are carrying importance in terms of bringing it on the balance sheet. If we understand this lease arrangement, what is a lease arrangement? It's nothing but a kind of financing arrangement. If we get into this detail. In fact, if we look at the finance lease accounting we have just discussed, what was happening? Initially, if you look at the lessee is getting the asset, lessee is also using this asset and paying a price for this. And in relation to this price, lessee is also recording an interest expense. Why? Because it's a kind of funding which the lessee is required to do, and that's why on this funding lessee is bearing the interest cost. If you also look at the accounting of the lessor, what is it that the lessor has been getting? Lessor has in a way funded the lessee. It's a kind of fund which has been given by the lessor and on which lessor has been earning the finance income. Correct? So it's a kind of funding arrangement between the two parties which has been colored in the form of a lease, if you look at it. Now, ideally, what should happen? This should also get reflected on the balance sheet of the company. Now, just because this arrangement is in the nature of an operating lease, what was happening earlier and what is currently happening under Indian GAAP, this is not getting recorded on the balance sheet of the company. Correct? Yeah, this is something which is not getting recorded on the balance sheet of the company. So that's why to look into this aspect, or you can just say take care of this aspect which was not really done under IND AS 17 and which is continually not done under the Indian GAAP, IND AS 116 was introduced, which requires companies which are lessees to record the leases on their balance sheet. So now, if you look at the requirements, of IND AS 116, under IND AS 116, even the operating leases get recorded on the balance sheet of the lessee, and we'll try to understand how. So if you look at this picture which is available in front of us, if it's a finance lease, we understand that the lease gets recorded on the balance sheet. So let's ignore this second column. Let's look at the third column. Now, in case of third column, if we look at the lessee side, under IND AS 17 and under AS 19, what is happening? Lessee is recording an expense and which is then paid off. So it becomes a liability which is then paid off. Now, under IND AS 116, you will understand this in more detail in the next 1 hour, that this expenditure is not recorded in the form of a lease expense. This expenditure is recorded in a manner which is somewhat similar to what you see in case of finance lease accounting. Means for operating lease, a right is recorded by the lessee in its balance sheet in the form of an asset. And what does this right represent? That right represents right to use an asset. Okay. And corresponding to that right, a liability is recorded. And what does this liability represents? That liability represents the liability to pay to the lessor over the period of the lease, which was nothing but a lease obligation. Okay. So now effectively what has happened? Now effectively under IND AS 116, we see that the lessee is also recording the operating lease in its balance sheet, which was not happening earlier. And just if you have to look at some of these aspects quickly, again, as I mentioned, I'll not get into too much details around it, because anyways, you are going to have a detailed discussion on all of these aspects in the next 1 hour. Under IND AS 116, for the lessee, now we are talking about the lessee, this lease classification is not required to be done. Means for the lessee, we will not assess whether the lease is a finance lease or an operating lease. Okay, why? Because in both the scenarios, accounting is sort of similar. Yes. So now under the new standard, that means IND AS 116, lease gets recorded on the balance sheet of the lessee, which is not the case under Indian GAAP, and which was also not the case under IND AS 17. Further, just to clarify some of these points, in case of a lease arrangement, we generally see that some services are also attached. For example, if you take a property on lease, so when you take the property on lease, so at times you are not only paying for the right to use, but for the maintenance, etc., sometimes the payments are made. Now, when you are making the payments for maintenance and similar such services, these payments are not made for right to use, but for the services which are availed by you. That's why such services are excluded from the purview of leases under Indian GAAP, under IND AS 17, as well as under IND AS 116. Okay. So as around these services, nothing has changed. They remain completely of this accounting requirement. Further, now this is again something which is very, very important for all of you, that now under IND AS 116, the way leases are defined has got completely changed. I would say completely changed because it's a big shift from what we understood. So if you remember the definition of lease under Indian GAAP, it required lessor to transfer right to use or convey right to use to the lessee. Remember? And lessee was required to make the payments to the lessor over a period of time. Now it could be a single payment or series of payments. But again, this is the aspect which you'll understand in more detail, but I'll just touch upon this definition. As per IND AS 116, if a lease has to be called as a lease, it requires two parameters. One, there has to be an identified asset within the lease arrangement. Now, this identified asset could be explicitly or implicitly specified, and for which no substantive rights to substitute should be there. Number one. So this is the first thing. This is the first aspect which is involved and which is very, very important. Because without this identified asset, lease will not become a lease. And means along with this identified asset, arrangement should convey right to control the use of identified asset. Now, please see this term. It's not the right to use, it's the right to control the use. And right to control the use of identified asset. Now, we didn't have any requirement of a specified asset. Now, what do you mean by identified asset? Means a specified asset. So under Indian GAAP, you don't see this requirement for a specified asset or a right to control. Now, for a right to control, again, standard says, how do you establish this right to control the use? There has to be right to obtain substantially all the economic benefits, and the lessee should also have the right to direct the use. If all of these criteria are fulfilled, if all of these conditions are satisfied, only then the lease will become a lease which is covered under IND AS 116. Now you can see significantly the way lease is defined has got changed over here. Yeah. Now moving further, talking about the way accounting is required to be done, we have discussed that the accounting for a lessee will not require classification test, first of all, and the lessee will record the asset and the liability in its balance sheet in case of an arrangement which was operating lease. Okay, because now we are not looking at whether the lease is operating lease or a finance lease. So that's why I'm not using this term. So that's why I'm saying that in all the lease arrangements, lessee will record the lease in its balance sheet. And let's see how it will be recorded. As we just discussed, that the lessee will record right to use. Right to use will be in proportion to the arrangement. So that means if the arrangement is for a specified period, then the right to use will be computed for the specified period. And of course, the obligation will be as against this right to use. This right to use or this right of use, which the lessee will record, will be depreciated over the period. And corresponding to this lease obligation, what will happen? Now, these lease obligations will be recorded at their present value. So similar to what we saw in case of finance lease, we will compute interest on this. So there will be an interest expenditure on this in such a manner that over the period of the lease arrangement, these lease liabilities will true up to their values at which the amounts are required to be actually paid. So that's why in case of an operating lease, now I'm just talking about this operating lease just to clarify, though there's no discussion of operating lease under the standard on IND AS 116, you can see that in the P&L of the lessee, there will be two charges. One, depreciation of this right of use, and second will be the interest in respect of this lease liability. Okay. Now, let's compare this accounting with the finance lease. In case of a lessee under Indian GAAP, you will find this to be completely similar, except for the fact that this right of use is a new term, which was not there under Indian GAAP. Why? Because under Indian GAAP, we were taking the substantial risk and reward. And because the substantial risk and rewards were getting transferred, so that's why this complete asset gets recorded in the book of the lessee, which is not the case under IND AS 116 always. Yeah. Now, as regards the lessor, for the lessor, the accounting requirements largely remain same. It has not changed. So that means for the lessor will continue to do the lease classification test into the finance lease as well as the operating lease. And this lease classification test, wherein we need to check whether it's a finance lease or the operating lease, will have this similar criteria. And same indicators are available. Those indicators like we discussed, transfer of ownership, bargain purchase option, covering a substantial portion of the economic life of the asset. So similar sort of indicators are available over here. So you can just say that for the lessor, the things are largely same. The things are not changing as compared to what is happening in case of a lessee. Because for the lessee, things have significantly changed. Correct? Yeah. So now, quickly looking at the accounting treatment for the lessor. Now, in case of a finance lease, what will the lessor do? Record lease receivable, de-recognize the underlying asset. Similar to what we see in case of Indian GAAP. And in the P&L, there will be financing. In case of an operating lease, what will happen? For the lessor will continue to record the asset. Yeah. And this will also be depreciated by the lessor. Okay. Now, let us just quickly compare some of these differences between Indian GAAP and IND AS 116. Under Indian GAAP, what did we see? For lessee, we saw there are two classifications. So you can say there are two types of accountings which are possible and which is also called as dual lease accounting model. Finance or operating lease. But under IND AS 116, it's a single lease accounting model. That means one which is in the nature of finance lease. Okay, I'm just calling this as a finance lease because this is something which we can understand in a better manner. And please understand that this dual lease model or the single lease model is in respect of the lessees only. For the lessor, the things are largely same. For this right of use, yeah. Now under Indian GAAP, what do we see? We see that the lessor is required to convey right to use. So therein you understand this concept of right to use. But under IND AS 116, as we just discussed, in fact, I have not gone into the details. So it's not the right of use, it's the right to control the use. Now, in relation to this initial direct cost, now this is also one of the aspects for the Indian GAAP versus the IND AS. If you look at the initial direct costs for the lessors, under Indian GAAP, what do? They are recognized as expense in the period in which those are incurred. Under Indian GAAP, whenever you incur, you charge it off, you take it to P&L. Under IND AS 116, what do? They are added to the carrying amount of the leased asset and they are recognized as expense over the lease term because they are forming part of the leased asset. Now, as regards the lease expense, lease rent under Indian GAAP, as we discussed, shall be recognized on straight line basis. We equalize them and equalized amount is recorded over the lease term. Whereas under IND AS 116, what do? It's not really the lease expense. It is now getting recorded in the form of an interest expense. So that's why whenever you pay an installment, as I discussed, as we understood that it's a kind of funding arrangement which has been availed. So whenever you will have a funding arrangement, what will happen? You will pay the EMIs and the EMIs will involve an interest component which will be significantly higher in the initial period. And as you keep paying it and towards the end of the term or this arrangement, the the EMIs will go down, wherein the interest component will also go down. So similar is the case under IND AS 116. Lease expense, which is something in the nature of interest expense or the finance cost, this is higher in the initial years and this goes down in the subsequent years. Okay, clear? Yeah. So with this, we come to an end to our discussion about this gap difference between Indian GAAP and IND AS 116. And as I discussed that we have just touched upon some of the concepts related to IND AS 116, but in the next 1 hour, when you will understand about IND AS 116 in more detail, I'm sure you will be able to relate to some of these concepts and you will be able to understand some of these differences in a better manner. All right, yeah. So with this, I would like to thank all of you from my side and over to Mr. Manish. If he can take this session in respect of IND AS 116.
Thank you, Achal. Thank you very much.
Munish sir?
Yes.
Sir, there are 2-3 questions for Achalji. In order to start your deliberation, may I ask questions to Achalji?
Sure, sir.
Achalji, 2-3 questions are there. First is, some company also create a lease equalization reserve. What is the purpose of creating the reserve, and is it applicable in the current context of IND AS 119?
So the purpose of creating the lease equalization reserve is the requirement of accounting suggested by Indian GAAP, which says that whenever there are the lease escalations, then instead of recording as and when the amount gets increased, you should at the time of the inception of the lease assess what will be the amount which is required to be recognized over the lease term and then recorded. I also talked about this with the help of an example that it may happen that in some of the years the amount paid is more than the expense which is recorded, and some of the years it may happen that the amount paid is lower which you can say gets reversed lease term complete. And, yeah, sure.
One more question is there: is sale cum lease back transaction applicable or valid in Indian AS scenario also?
Yes, that is valid in India scenario also. Yes.
Indian AS scenario also.
Yes.
And it is there in view of the different discounting factor used by the leasing lessee and lessor. Can different amount of receivable, that is for the lessor, and the liability for the lessee, and will appear in the balance sheet of respective parties?
Yes, it's possible because the discount rate for two parties could be different. Though the standard talks about the discount rate which is implicit in the lease should be considered, but at times it's difficult to be ascertained, wherein the standard also requires you to get into the incremental borrowing rate for the party, which would be different for two. It's not necessary that for two parties, which is recorded as asset and the liability will always be similar. There could be differences. So which is excellent. Yes. And this is something which you commonly see also.
Yes, sir. So these were 2-3 questions for you, and we are having with us CA Munish Sharma ji for the detailed discussion on IND AS. You are with us, Achal ji, na?
So I would request you to excuse me.
Okay, sir. On behalf of CNP of ICAI, I extend my heartiest thanks for sparing your valuable time and enlightening all of us on this various intricacies, sir. Thank you so much, sir. Thank you, Achal. Thank you so much.
Thanks.
We are having with us our another guest speaker, CA Munish Sharma ji. Munish Sharma ji is a practicing chartered accountant and carries over 17 years of vast experience with Big Four firms in the assurance division. He has also done MBA from XLRI Jamshedpur and completed diploma in IFRS from ICAI UK. Munish's expertise in audit, transaction restructuring, capital market transactions, and gap conversions. Munish has also strong understanding and knowledge of accounting requirements and complexities, and has performed audit of other RS engagements across industries and regions. So Munish ji, welcome to you. So once again, I request Munish ji to please start his detailed deliberation on IND AS 116. Please, sir.
Thank you so much, and I would also like to thank Achal, who has given a good presentation on the accounting standard on leases, and he also covered a bit details about IND AS 116. So in today's session, we will be covering IND AS 116 in more detail. Just to set up the context, MCA has introduced this IND AS 116 in 2019, which means that all financial year which began after 1st April 2019, this IND AS 116 was applicable to them. Now, typically what it does is that this replaces the erstwhile standard in IND AS, which was IND AS 17 on leases. Now, let us try to understand the thought process behind why this change was required, why there was a need for a new standard, which was 116 and the corresponding standard, which is IFRS 16. First of all, the erstwhile standard does not go beyond the legal form of the lease agreements. So we have seen in the previous session that there were two types of lease agreements. One was the operating lease, second was the finance lease. And practically the public at large were manipulating, or you would say they were structuring their lease agreements to suit the accounting requirements as per their whims and fancies. So in order to plug out those loopholes or the anomalies which are there in the accounting world, this new standard has been introduced. Now, what does IND AS 116 offers? So IND AS 116 is fully converged to IFRS 16. So when I say fully converged means that it is a replica of what IFRS 16 is. There are two concepts which have been introduced into the standard. One is right to use and lease liability. We will be discussing about these two concepts in our subsequent slides. Then there are certain assumptions which are available. We will be discussing those assumptions, those practical assumptions which have been given by the standard. And on an overall basis, if you will see that, this standard 116 gives a very practical and a very transparent view of the entire accounting, and it gives you a holistic view of what the rights of a lessee are and what are the obligations of these lessees. And both these rights and obligations get captured in the balance sheet. Now, quickly, an overview of IND AS 116. We will be talking about these things in much detail. I have collated one slide for you just to give you a perspective that, what does this 116 looks like for companies which have actually converged to IND AS 116. Let's talk about the aviation industry. We all know that, in aviation industry, all the aeroplanes and all the aircrafts, these are taken on lease. Typically, what was happening under the erstwhile standard is only the lease rental cost was getting captured into the financial statements. Nowhere in the financial statement there was any right or an obligation which was getting captured. So more of it was a expense which was getting captured in the other expenses in the form of lease rentals. Now, in case of Interglobe Aviations, when they adopted this IND AS 116 for the first time in way back April 2019, they created a right of use amounting to 93,942 million. And they recognized a lease liability amounting to rupees 1,46,320 million. And their retained earnings decreased by 6,180 million. So, you can just see the impact of the standard, that what a magnitude this standard can have on companies like Interglobe Aviations. The second example, which I would like to quote, is the Indian Hotel Company Limited, which is the Taj Hotels. So typically Taj Hotels take premises, hotels on lease. So the lease cost for the year when they converge to the IND AS 116 was lower by 86 crore rupees, which had an impact of increasing the EBITDA of the company. And their overall profits, they went down by 21 crore rupees. Likewise, in telecom industry, Reliance Jio, when they adopted IND AS 116 on the tower assets, which were earlier taken on lease, Jio reported a quarterly EBITDA of 37 crores to 4670 crores. That was the increase in EBITDA because of the adoption of the new standard, and which was at that time 26% ahead of the expectations of the market. So you can see that it is just by a mere implementation of a standard, how the financial position of the companies have actually improved, how the EBITDA of these companies have actually improved, how the balance sheet size has increased for such companies. So today's session roadmap is I have bifurcated this entire session into 5 segments. Segment 1 will be talking about the scope of IND AS, the definitions, will be covering out the right of use, we'll be talking about the non-lease components, lease term, and likes of those. Segment 2, we will be talking about the lease accounting. Segment 3, lesser accounting. Segment 4 will be talking about the lease modifications, subleases, sale and leaseback transactions. And the last segment, we will be talking about the impact of COVID-19 on IND AS 116. Let's start with our segment 1 with the definition of leases. So lease has been defined as a contract or a part of the contract that conveys the right to use an asset for a period of time in exchange of a consideration. So definitely, agreement will be classified as a lease if there's a right to use a particular asset. The asset should be identified in the lease. Period of use of that asset should also be defined in the lease, and there should be a consideration for which the lessee is using that asset. Now, not all leases are covered under IND AS 116. There are certain exemptions. So leases for exploration of oil and gas and similar non-renewable resources is not covered under 116. There's a separate standard, IND AS 106, which covers this aspect. Lease of biological assets held by the lessee is also not covered. It is covered under IND AS 41. Service concession agreements is not covered. License of intellectual property granted by the lessor is again not covered here. It is covered under IND AS 115. Rights held by the lessee under the licensing agreement, motion picture rights, patent rights, copyrights, these are also not covered. So there are specific standards, IND AS 38, intangible assets, which cover this. So any leases other than these 5-6 leases which have been categorized below, IND AS 116 will be applicable. Now, IND AS 6 gives two practical assumptions to implementation of the standard. The first assumption is short-term leases, and the second assumption is leases for which the underlying value of the asset is known. So these setters of the standards have said that if any lease period, any lease agreement which is less than 12 months in nature, so you don't apply IND AS 116 to that standard, to that particular lease. And second, if the value of the lease is low, then there's an exemption to apply IND AS 116. So the standard says that the lessee can benefit from the use of the underlying asset on its own. So if you have an independent asset whose value is not very high, or it's a low value and is not highly dependent on any other asset, then the company can avail the exemption of a low value lease. A typical example for low value leases can be leases for table or chair, or it can be any laptops or equipments which are taken on a low value leases model. In IFRS 16, there's a threshold which is defined for identification of low value lease, but under IND AS 116, no threshold has been defined for identification of low value leases, which means that the low value will depend upon company to company and will also depend on the respective materiality which is being exercised by the company while preparing the financial statements on a whole. Now let's see what is the definition of lease. So like we have seen in the previous slide, if there's an identifiable asset, if the answer is no, that there's no identifiable asset, that means that contract doesn't contain a lease. And if the answer is yes, that yes, there's an identifiable asset, does the customer have the right to obtain substantially all the economic benefits from the use of the asset throughout the period? So the person who's taking asset on lease should be able to enjoy all the economic benefits out of that particular asset. If the answer is yes, then we move to our next decider point, which is right to direct how and for what purpose the asset is used throughout the period of the lease. So I should have an identifiable asset, I should have the right to use, and I should also have the right to direct the particular use. So in case all of these three conditions are applicable and these conditions are with the customer, this means that the contract contains a lease. And in case these conditions are not there and these are there with the supplier, then that contract doesn't contain a lease. This particular identification of lease is very important before we start the implementation of IND AS 116. Now let us see what do we mean by right to use an asset. So identifying the right to use an asset can be categorized as what is the most relevant right for using that asset. If it is a car, so what is the most relevant right for using that asset? How that asset can be used? Are the decisions taken, are the decisions which are related to that asset are predetermined? of how that asset will be used. So basically, if all these rights are there with the customer, then that means that customer has the right to use those assets. And if all these rights which lies with the supplier, this means that the right to use as asset lies with the supplier. In substantive substitution right, this means that in case the supplier has the capacity to substitute the asset, suppose I'm using an asset which can be substituted by the supplier at any point of time, that means that the customer does not have the right to use that asset. It is the supplier which is actually exercising the right over that particular asset. So in case of a leases, it is very important that the customer should have the substantive rights over the particular asset, then only it can be categorized as a asset. Now let us take one example. Let's see that customer X enters into a contract with supplier Y to use a vehicle for 5 years period. So there's a customer X and a customer Y. They both enter into an agreement for 5 years. The vehicle is identified in the contract. So there's a specified vehicle which is there in the contract. Now supplier Y cannot substitute another vehicle unless the specified vehicle is not operational or it breaks down under the contract. So customer X operates the vehicle, he drives the car as per his whims and fancies, or he directs others to operate the vehicle, or he has a driver, he has given his car to a driver, and that driver drives the car. Now customer X decides how to use the vehicle within the contractual limitations. For example, throughout the period of the use, customer X decides where the vehicle will go, as and when this vehicle will be used. So the entire use of the vehicle is restricted or lies with the customer X. Now the supplier Y prohibits certain use of the vehicle. That is, the customer cannot take the vehicle overseas, or he cannot do a modification into the vehicle. So in this case, who has the right over the asset or the vehicle? Does customer X will have the right over the asset, or supplier Y will have the rights over the asset? So in this case, customer X has the right to direct the use of the identified asset throughout the period of use, because it has the right to change how the vehicle is used. Supplier Y only has the protective rights. So being in the owner capacity, his rights are only restricted in a prevention category. That means his asset cannot go overseas, or there cannot be a modification in an asset. So here we can say that customer X has the rights over the vehicle. Now let's take another example. Now entity A contracts with supplier H to manufacture parts in its facility. Entity A designed the facility and provide its specification. So entire design of the facility has been provided by entity A. Now supplier H owns the facility and the land. Entity A specifies how many parts it needs and when it needs. Now supplier H operates the machinery and makes all operating decisions. So this is very important, that supplier H is operating the machinery and is also making all the operational decisions, including how and when the parts are to be produced, as long as it meets the contractual requirements to deliver the specified number of the cases to be determined. Now, assuming H cannot substitute the facility and hence is an identified asset. So now we have an identified asset, but the entire rights and entire operating decisions lies with supplier H. So in this case, supplier H will be considered as the person who's actually having the right over the identified asset, because he is actually controlling the entire asset. Now, the first task in IND AS 116 is to separate lease and non-lease components. Sometimes there are contracts that contains the use of multiple assets. So suppose somebody take building on rent. So there are certain equipments which also come under the leasing agreement. The right to use each such asset is considered as a separate lease. So if and only if we will be considering the right to use such assets as a separate lease, if the lessee can benefit from the use of the assets on its own or together with other resources that are readily available to the lessee. So in this case, if the lessee has the capacity to use those assets on its own, then we can say that these are separate identifiable assets into a lease. And the second condition which needs to be met is the underlying asset is neither highly dependent or nor highly interrelated with the other underlying assets in the contract. Now, if both these conditions are satisfied, then the right to use multiple asset is considered as a single lease component. Now, let us see what is a lease term. Now, lease term is the non-cancelable part of the lease, plus the period covered by an option to extend that lease. So if the lessee has a option to extend that lease, so suppose let's say the initial lease period was for 3 years, and there's an option on the lessee to extend this lease for another 3 years. And there's a reasonable possibility that that the lessee will exercise this option. It is certain that he'll exercise that option. So we will also add that extension period. And plus we'll also add period covered by the option to terminate. So in case there's an option to terminate that particular lease, that is also covered under the lease term. Now we need to understand while assessing the lease term, what is reasonably certain. We have mentioned that the lessee is reasonably certain not to exercise or to exercise certain options. So the first condition that needs to be considered is the contractual terms, conditions for option period compared with the market rates. So the market rate should be favorable in exercising those options. Significant leasehold improvements undertaken. Suppose a lessee who has undertaken significant leasehold improvements into a lease premises. So we can say that, there's a reasonable certainty that he might extend that lease for another period because of his stake involved in the form of leasehold improvements. Now, next point is cost relating to termination of lease or signing a new replacement lease. Suppose the exit clause in an agreement is so high that it is impossible for a lessee to terminate that lease during the lease period. So that point should also be considered while making an evaluation of the lease period. Importance of underlying asset to the lessee's operations. Suppose the particular asset is very critical to the operations of the company. In that case, it is assumed, or it can say that it is reasonably certain that that person will extend that lease for a particular period of time. And any conditions which are associated in the lease term or the lease agreement, which needs to be exercised by the lessee. So when all of these conditions are certain, we will determine that, this is the lease term for which the lessee and the lessor has entered into a lease agreement. Now, let us see what is the accounting from a lessee and a lessor perspective. Though we have covered this in the previous session, I'll quickly run you through. In IND AS 17, there was a finance lease and an operating lease. In finance lease, the companies typically used to show an asset and a lease liability in their balance sheet. And in their statement of profit and loss account, they used to get depreciation expense and an interest expense. And in case of operating lease, there was nothing used to come on the balance sheet phase, and only lease rental expenses were shown in the profit and loss account. So this was an overview of IND AS 17. Now let us see how this has changed in case of IND AS 116. Now all the leases on the balance sheet date, the lessee has to create a right to use in their balance sheet. Right to use is nothing but an asset which will be shown in the balance sheet of the lessee. There will be a lease liability which will be recognized on the liability side of the balance sheet. There will be a depreciation expense in the profit and loss account, which will be nothing but the amortization of ROU, which is the right of use of an asset. And there'll be an interest expense, which will be shown in the profit and loss account on the lease liability. Now, what is right of use? Right of use is typically equivalent to the lease liability. Whatever lease liability one has to pay over the contractual period of lease is the lease liability, plus any lease payments made before the commencement of the lease period. So if any money has been paid before the commencement of the lease, that will also be considered as a part of right of use. Any initial direct cost incurred by the lessee. So any cost which was incurred before the lease will also be covered, and any restoration cost in case the lease agreement has any clause which says that the site needs to be restored once that premises is vacated. This is typically there in cases of mining leases where mine needs to be restored. So any potential restoration cost will also form part of the ROU. On the other hand, lease liability is nothing but the present value of the lease payments. So whatever lease payments we have to pay over the life of the lease agreement, that present value is the lease liability. This lease liability is calculated using a discounting rate, which is the rate of interest implicit to the lease. And in case the interest rate is not there in the agreement, we take the incremental borrowing rate for the purpose of calculation of lease liabilities. So let us see with the help of an example how this ROU and lease liability is calculated. Now let us see entity ABC enters into a 3-year lease of an equipment. Now, entity ABC agrees to make the following annual lease payments at the end of the year. So year 1, 20,000, year 2, 30,000, year 3, 50,000. Now, for the sake of simplicity, we are not considering other elements of the lease payments like purchase option, lease incentives and all. It is assumed that the discounting rate is 12% and entity ABC depreciates the ROU over a straight line basis over the lease term. Now, how would entity ABC would account the lease under IND AS 116? Now, let us see all the payments which are to be made over the next 3 years, which is 20,000, 30,000 and 50,000. These will be discounted using the discounting rate, which is 12%. So what we have done is we have calculated the present value of the lease payments, which is 1 lakh rupee. Present value of 1 lakh rupee using discounting rate of 12% comes to 77,364. Now 77,364 is my lease liability. So what I will do, I will create a lease liability in our books at the inception of this lease, which is 77,000. And I will create an interest expense over this 77,000 at the rate of 12%. And this interest expense will be charged to my profit and loss account. And whatever lease payments are to be made will be reduced from the lease liability. And balance is the closing balance of lease liability. So at the beginning of the year, our lease liability was 77,364. And the closing balance is again 66,648. Next year, this 66,648 will become the opening balance. And again, an interest accretion will be done at the rate 12%. And lease payments will be made at 30,000 with a closing balance of 44,646. In the end of third year, this will be the opening balance. Interest accrete will be done for 5354. Lease payment will be made for 50,000 and closing balance will be 0. So we have seen that how in year 1 a lease liability was calculated and how this entire lease liability got unwind and this became 0 at the end of the lease period. Now let us see what will happen to the right to use an asset. So we have seen in the previous slide that ROU is equal to the lease liability. So here the lease liability was 77,364 at the inception of the lease. Now we'll have an opening balance of 77,364 as a ROU, and this will be shown as an asset in the balance sheet. This will be depreciated over a period of 3 years. So we'll have a depreciation expense on depreciation, which will be 25,000. So my opening balance 77,000, depreciation for the year 25,788, and closing balance is 51,567. Next year, same opening balance, depreciation for 25,000 and closing balance of 25,000. And in year 3, we have seen that the entire ROU has been amortized. So what has happened in this particular example? In this particular example, the company has made a lease payment of 20,000, 30,000, 50,000. We created a lease expense into our profit and loss account in the form of interest expense and depreciation. Now, interest expense will go to the finance charges, 9,000 in the first year, 7,000 in the second year, and 5,000 in the third year. Depreciation expense will also be charged to my profit and loss account in the form of 25,000 each per year. So my total charge to profit and loss account is 35,000 in the year 1, 33,000 in year 2, and 31,000 in year 3. So on an overall basis, if you see the impact on EBITDA, both interest and depreciation are not considered for EBITDA. So by adopting the IND AS 116, what happened in this company is my EBITDA has gone up by 35,000. Only by implementation of this new standard, there's an increase in EBITDA by 35,000, 33,000, 31,000 in respective years. And in our balance sheet, in year 1, there'll be a 77,000 ROU and an equivalent liability in the books. And thereafter, this will be depreciated, the ROU will be depreciated and lease liabilities will be paid. And at the end of the lease, we'll have zero balances. So I hope with this example, you got an overview of how the accounting is to be done for leases and how ROU is created and how a lease liability is created in the books of accounts. So let us see what will be the journal entries. So the first journal entry will be ROU account debit to lease liability with the 77,000. Then interest expense debit to lease liability by the interest amount that we have seen in the previous slides. Depreciation expense account debit to ROU. This will be the depreciation which will be charged to the profit and loss account. And last entry will be lease liability account debit to cash in bank. That is the lease liability which was created will be paid to the lessor over a period of time. We have seen what accounting is to be done in case of a lessee. Now we will see what accounting will be done by the lessor. So on a nutshell, on a broad basis, for a lessor, nothing has changed in comparison to what was done earlier. The entire 116 revolves around the accounting for the lessee. So in case of finance lease, so in case the leases have been identified as a finance lease, the lessor recognizes the assets held under the finance lease in the balance sheet and present them at the recoverable amount, which is equivalent to the investment. So whatever value of investment which was appearing, what is the value of the lease which of asset will be there, will be shown as an asset in the books of the financing company, the lessor company, and that will be amortized or depreciated over the life of the lease. In case of operating leases, the lessors are required to present the underlying asset subject to operating leases according to the nature of the asset as per the requirements of IND AS 116. So there are specific disclosure requirements which are there in which are applicable in case of finance lease and operating lease, and these have been shown on the bottom side of the screen. I'll move to the other slide. Now let us see the concept of lease modification. So till now what we have seen is we have created a lease, we have entered into a lease agreement, and we have done the accounting in the books of the lessee in the form of a ROU and a lease liability. The next aspect is, suppose there's a modification in the lease. It happens practically that once a lessor or lessee enters into a contract, that contract is modified based on the market conditions or the practical aspects of the agreement. So let us see, in case of there's a lease modification, what will be the accounting in the books. So a lease modification can be done in three ways. Either the consideration which is payable, which is the lease rentals, these get changed. There can be a change in the lease term. Suppose the agreement was for 3 years, then the agreement changes to 5 years or 2 years. So there's a change in the lease term, or there could be a change in the scope of the agreement. So let us see that if there's a change in consideration, which is the first point. So whenever there's a lease modification which leads to a change in the consideration, the lease liability is remeasured on the modification date, and the corresponding adjustment is to be made in the ROU. So it makes perfect sense that, we created a ROU at a particular date, and at a later date, there's a change in the agreement between the lessor and the lessee. So I need to remodify my asset and liability, which was created in the books, as per the change in the consideration value. Now let us see that there's a change in the lease term. So suppose the first case, there's an increase in lease term. Initially 3 years, now this lease changes to 5 years, which means that if there's an increase in lease term, we will remeasure our lease liability based on the new lease term, and we will also adjust our ROU based on the revised lease term. Now let us assume that there's a decrease in the lease term. So any decrease in the lease terms will lead to a derecognition of lease liability and ROU to reflect the total lease term entered with the lessee, with the lessor. And any change is to be recognized in the profit and loss account on the termination of the lease. Now let us see that there's a change in scope. So if the scope leads to a decrease, so any change which leads to a decrease in scope will again lead to a derecognition of lease liability and an ROU. And any change in scope which leads to an increase in the scope and for which the considerations are not commensurate with the standalone selling price, there's a requirement to remeasure the lease liability on the modification date and change the ROU. And where the considerations are commensurate with the standalone selling price of the asset, the increase in scope of the lease of the underlying asset is accounted as a new lease. So we'll be accounting as if it's a new lease. Now let us take one more example where the lessee has subleased an asset. So there's a lessor who has given an asset on lease to a lessee. So let us see, there's an original lessee, and this original lessee has subleased this asset to another lessee. So this initial lessor and lessee are considered as the head lease, and the subleasing is considered as a sublease. Now let us see what will be the accounting for this intermediate lessor. Now, if the sublease is classified as a finance lease, so there could be two aspects. One is either it's a finance lease or an operating lease. So the intermediate lessor will derecognize the ROU on the head lease. So this person who's the intermediate lessor, he will derecognize the ROU which was created at the time of entering into a lease agreement, the original lease agreement, and the head lease, and continue to account. So the lease liability, he will continue to recognize the lease liability in its book as it is, but the ROU will be derecognized. And this person will recognize a net investment in sublease on its balance sheet date. So what will happen is I will derecognize the ROU and I will create a net investment in my books in case of a finance lease. So from a balance sheet perspective, nothing has changed. From the ROU has been derecognized and an asset has been created, which is the net investment in the sublease equivalent to my ROU. So more of a reclassification has happened here. In case of operating lease, the original lessee continues to account for the lease liability and ROU as it is. So from a lessee perspective, there is no change. He'll continue to account for both the ROU and the lease liability in its books of accounts. Now, if the total remaining carrying value of the ROU on the head lease exceeds the anticipated sublease income, so I'm carrying a ROU in my books for 100 crore rupees, and from the sublease, suppose the expected returns are around 80 crore rupees. So the difference between these two is an impairment charge in my ROU, because whatever ROU I have created in my books, my sublease is not in a position to cover that particular exposure in my books. So that delta 20 crore rupees will be charged as an impairment to my ROU. Next transaction is sale and leaseback transactions. Now, typically a sale and leaseback transaction is a person sells an asset to a seller, and the seller leases back the entire asset back to this person. So typically a sale and leaseback transaction involves the transfer of an asset by an entity, which is called the seller lessee, another entity, which is called the buyer lessor, and the leaseback of the same assets by the seller lessee. Now there's a accounting which is prescribed under the standard, which says that in order to determine whether the transfer of assets should be accounted for a sale purchase, both the seller lessee and the buyer lessee shall apply the requirement of IND AS 115, which is the revenue recognition standard, on when an entity satisfies performance obligation of transferring control. It means that if the control of the asset is transferred in sale and lease transaction, then the buyer lessor accounts for this transfer as a sale or a purchase of the asset of the lessee. And in case the control is not passed, then the buyer lessor and the seller both accounts for this lease as a finance transaction. So if I'm passing the control, this will be accounted for as a sale and purchase of an asset. If I'm not transferring this control, I'm retaining the control. This means that this is a more of a financing transaction between the seller and the buyer. Now let us see, we all know that COVID had many hardships on the companies, and there were a lot of rent concessions which were given in the pandemic period. Now, the financial there were many concessions which were given by the lessors due to COVID-19, which includes there were some deferrals of rent to future periods. Lease rental collections were foregone or forgiven, or the part of the lease rent being deferred to future periods, or they were foregone. So typically IND AS 116 requires any change in the lease terms to be classified, or any change in the terms of the lease to be classified as a lease modification, which needs to be accounted for as per the requirements that we have seen earlier. But as per the notifications or as per the relaxations given under the standard, it was assumed that any change in the lease agreement in the form of a deferral of rent or any rent concessions which are given, and practical exemption will be given to the lessee, which means that the accounting for lease modification is not to be followed, and that accounting they can continue as if the lease modification has not happened. So typically when a lease modification happens is one needs to recalculate this lease liability using the discounting rate which are applicable at the time. Corresponding adjustments in the ROU needs to be created, and one needs to recognize change in lease payments arising on account of lease modification in the profit and loss account. So this particular exemption was given, but there were certain conditions which needs to be met before this exemption was applicable, or this could have been applied. The first condition is the rent concession must occur as a direct consequence of COVID-19 pandemic. It should not be that I have entered into a normal modification of a lease agreement with my lessor, and that is not on account of COVID-19 pandemic. Then this exemption will not be applicable, and accounting is to be done as per the lease modification. The change in lease, the second condition is the change in lease payment result in revised consideration for the lessee that is substantially same or less than the immediate lease period or the lease payments. The third condition, any reduction in lease payments affects only payments originally due on or before 30th June 21. So this cutoff date is very important. So all lease payments or exemptions or reduction in the lease payments which were effected before 30th June 21 are only covered under this exemption. The fourth condition is there is no substantive change or other in the terms and conditions. So other terms and conditions related to this particular lease agreement should not change and should remain the same. So when I'll follow all these four conditions, then the practical exemption can be availed for IND AS 116. I'm done with the presentation.
Sir, there are two questions for you.
Yes, sir.
So first one is, does the provision of wet lease option also is used as a part of lease contract, or same needs to be treated separately and expensed off for wet lease?
I am not aware of this particular question. Maybe I can get back to you on this. Wet lease.
Yeah, I'll mail you. This is relating to, I hope this is relating to the aircraft.
Is it wet or wet? What is
wet lease?
Okay, I'll get back to you on this.
I'll mail you. And another question is whether fixed maintenance charges paid for rental property will be taken in consideration in calculation of the lease asset for that property?
Correct. That's right. That needs to be considered.
That is to be considered. So we have received these two questions for you, and thank you very much for the wonderful deliberation. We have gained a lot through your deliberation as well as from Achal sir deliberation. So on behalf of CMP, I extend my heartiest thanks to both the speakers, yourself as well as the Achal Jain ji for sparing your valuable time. Thank you so much, sir. Thank you.
Sure. Thank you.
Thank you. Thank you.